Hi friends, welcome to Adda 24/7. We are in the BFM most important questions and case study series. We are covering case studies as well as objective questions over here. So today we'll be covering the case study, numerical case study, as well as some objective questions. So follow the video till the end. Follow the complete series. There's a playlist given. Follow it completely. Share it with your friends. Share it on all your social media platforms. Like the channel, subscribe to the channel, click on the bell icon. Don't miss this, okay? Because this is very important. You see, daily new case studies are taken, daily, okay? So don't miss it. So let's start. A bank purchased an export bill for USD 50,000 at 42.66, which was dishonored for non-payment. See here, dishonored means payment was not received, okay? So bank purchased the export bill. Purchase means what? It has purchased means it has financed earlier. How much amount will be recovered from the exporter if the spot rate is 42.2030 and exchange margin is 0.15%? So what has happened? Firstly, understand this. This is purchased over here and now it is for the due date. Today is the due date. Now no payment, no money. So now you'll have to cancel the contract. This was a buy contract. Purchase means buy contract. Now you will have to reverse it. Reverse means sell. So you'll have to use the sell rate now. What is the sell rate now? See here, 42.66 is of no use over here because 42.66 was over here. Generally what we do in banking, this rate or what is the today's rate then? 42.2030. So it is 42.30, right? Because sell, you are using the sell right side now, okay? So generally in practically I'll tell you what we do. In practically we do 46.66 or 42.3, whichever is higher for sale. Contracted rate or present TT rate, whichever is higher, that we do it. But over here, what can you in numericals, in exam numericals, you can't do this, okay? You have to use whatever is the spot rate. So 42.30 you will be using, and margin. What is the TT margin? TT margin is 0.15%. So 0.15 upon 100. Why? Because it's percentage. So what is the answer now? 42.30 into 0.15 upon 100. Everyone, try it yourself. Yeah. Everyone, give me the answer. It is 42.30, right, into 0.15, correct? 42.30 into 0.15 upon 100, obviously, percentage. So what is the answer? Comment section, everyone. So it is 0.063, correct? Many of you have got it correct. 0.06345. Okay, means big number. We'll just take first. Here you are selling, add the TT margin. So add this 42.30 plus this, add these two. So what is the answer now? 42.30 plus 0.0634. So plus 42.30, okay, plus 0.063. So 42.363. So your answer will be 42.363. Okay, this is your final answer. Got it? Clear? Next one. Okay with this? Let us borrow from one center and lend at the other center at a higher rate. In USA, the rate of interest is 6.5%, whereas in France, the rate of interest is 3% for euro. USA will be for dollars and France is for euro. We will borrow from France and lend to USA. Why can't we do the reverse thing? Borrow from USA and give to France. What is the business? Buying at a lower rate and selling at a higher. So business, where is the lower rate? France. So I'll buy from France and sell it to USA. But whatever I earned in this, the real question is whatever I earned. So earning means what? Earning equals to the difference. What is the difference then? Difference is, what is the rate in USA? 6.5% minus 3%. So it is 3.5. This is what I have earned. Now this is in percentage, but what is the actual amount I have earned? So per dollar. Now per dollar, how much will I earn? Per dollar. Okay, I'll earn. Let's see that. So it is what? PNR upon 100. PNR upon 100. We also call this as a forward point, right? So what is P? Per dollar. So 1.5 USD per euro. What am I earning per euro? Okay. So my principal is what? 1 euro means 1.5 USD. So 1.5 in 1 year. See here, these all interest rates are for 1 year. So 1.5 into 1 into what is the difference now? R, rate of interest, 3.5 upon 100. So get the answer now. Such a simple problem, 1 mark problem. Okay, but very important. 1.5 into 3.5 upon 100. Okay, so it is 0.0525. 0.0525. This is the margin I have earned per euro. This is per euro I have earned this much. Now you'll say, what is this? So less. But imagine I'm talking of 1 euro over here. If I talk of 10 crore euros, how much will I earn? That's it. Because forex deals are done in such big amounts. Okay. Now let's focus on some objective questions. But before that, everyone again subscribe to the channel Officers Adda 24/7 English channel as well as Hindi. Join the crash course without fail. Very important numericals are taken. I share various PDFs over here. So join it immediately. You can join the Mahapack also. In Mahapack, you will be getting 15 plus batches. I'll show you at the end how to join. Let's move on. First question. Which of the following are the objectives of using derivative products by the Treasury? Objectives of using derivatives products by the Treasury: to manage the liquidity ALM risk, to meet the requirements of the corporate customers, to trade in the currency and rupee derivatives, and all of the above. So which of them can be the objectives of trading in derivatives? And why do we use derivatives? Here, what are derivatives basically? What are derivatives? Derivatives means, look at this word, it is derived. Derived means it is derived from a underlying, that's called as commodity. Underlying, we call it underlying. Okay, means basically commodity. It is derived from some commodity. Okay, and then it is derived over here. Derived, it doesn't have its own existence. Okay, so suppose, for example, if I am having this gold, so I can have the gold derivatives. I can have the gold derivatives. If I am having dollar, then I can have dollar derivatives. Means generally derivatives are used in the treasury to prevent the downside risk. Always remember. Means if you buy gold, this is called as long position. If you buy gold, buy. Okay. Buy gold, this is known as long position, long. So once you buy gold, you take a long position. You have to take the reverse position in the derivatives. You will buy put over here. Put means what? Put is always related to selling. Okay, so you'll have to buy put. So this is basically, derivatives are used just to, importantly, at least in your CAIIB, they are used to cover your risk. That is the first part. So to manage the liquidity ALM risk, to meet the requirements of the corporate customers, correct, that is also true. Because many of the customers come to you nowadays for having this derivatives needs, because everyone knows now there is a huge money in derivatives. Many of you also might be trading in this options market, right? Call and put. Of course, many of you might have lost the money. That's a separate part. But we trade, right? So it is basically used for the corporate customers also, because everyone understands today. And third one is to trade in currency and rupee derivatives. Why do we want to trade in currency and rupee derivatives? To earn profit. This is to earn profit. Okay. So always remember, earn profit. What are the three aims then here? Earn profit. So answer is all of the above. Okay. It prevents the risk also. It earns profit also. Okay. Next one. The treasury is planning to invest in a scheme in which it has to deposit 18 to 50 now, for which in return the treasury would get rupees 5,000 year end for each year of the next 5 years. Now advise the chief treasury officer concerning the investing in the scheme on the basis of required rate of return. Means basically you have to advise this treasury guy that whether you should accept this or not, and at what rate of interest do you accept it. So accept only at 10%, only at 12, accept at both 10 and 12, reject at both 10 and 12%. Now what is all this? Firstly, understand this question is similar to that of your present value problem. Okay, present value. Now what is the present value problem? Now look at this. Present value problem means you had this in your JAIIB also. What is the formula for present value? See here, you are getting it at a year end. So what you have to do is, it's a annuity, okay, and this annuity is what? This annuity due or ordinary. So it is ordinary because you are getting it at the end of the year. Okay. So in this case, what you'll have to accept is, you'll have to accept any project which will give you the present value. Look at this here. Right now, how much money is going out? 18 to 50 is going out now. So in future, what is the money coming in? 5,000 every year. 5,000 every year. Into means I'll just write it into 5. Okay. So I'm getting net 25,000. But this 25,000 is of no use. I want the present value of this 25,000. Present value of each 5,000. So how will I get this present value? The present value formula is, you had this, that's what I said. In your JAIIB you had it. PV equals to C into, remember this anyone? 1 plus R raised to N minus 1 the whole upon R into 1 plus R raised to N. Right? This is the formula for ordinary annuity. Same formula you'll have to use it. Now what are the options given? Look at the options and choose those options. Both of them you'll have to solve it. C is what? Your 5,000, what you get every year. 5,000 you are getting it. R is what? Now there are two R's. One R is, everyone pay attention now. One R is, I'll write it over here. R equals to 10%. Look at the options given. And second R is R equals to 12%. Okay. So you'll have to use the calculations 2 times. Okay. And what is the N? N is common. N is 5 years. N equals to 5 years. So you'll have to use this formula 2 times. So let's write this present value equals to 5,000 into, I'll do it for 1, okay, 1 plus R, 1, what is R? Let's take it 10. So 0.1, 10 means 10 upon 100. So 0.1 raised to 5 minus 1 the whole upon R means 0.1 into, again the same over here, 1 plus 0.1 raised to 5. Okay. So what is the answer now? Find out the answer for this. Use the calci. Everyone, try with the calci. Let me see who gets the answer first. (1.1 raised to 5). Keep it simple. 1.1 raised to 5. Raised to 5. Use it into equal to 5 times. You'll get this as 1.61. So suppose if I take this, I'll write this separately. Look at this. I'll write it 1.1 raised to 5. Right? This one equals to 1.61 something, isn't it? 1.61. Let's take it only 1.61. Okay. Now this 1.61 will be used all the time, means in the numerator also, in the denominator also. So it is what? 5,000 into 1.61 minus 1. 1.61 minus 1. So it is 0.61. So 0.61, right? Do it everyone. Everyone. This is your JAIIB. In JAIIB also you had the same problem, right? Upon R. This is 0.1. Upon again 1.61. So it is 3.79 into 5,000 into 5 So it is this part is coming out to be 3.79, this part. Okay, this part. So that into 5000 now. If you multiply this, you'll get it what? What is the answer you guys are getting? Let me see. See here, you have to try this because these questions come to you in exam. 18959. So this is 18959. Is it greater than whatever I have invested? It is greater than 18250, right? So this I can accept it. Now let's look at 12% also. If I take this 12%, what am I getting? Look at this. P equals to 5000 into what? 1 point, directly I write it now, 1.12 because 12% raised to 5 minus 1 the whole upon 0.12 now, right, into 1.12 raised to 5, right? Solve this everyone. Now give me the answer directly. Everyone be fast. Okay. So 1.12 raised to 5, how much are you getting? 1.76, right? What is the answer? Are you getting the answer as, let me see first in the comment section. If I give you the answer, everyone will get the same. Let me see how many of you are getting this. Everyone please, yes. This is sort of case study, okay? So this answer which you are getting is 3.61. This is what answer I am getting, 3.61. So 3.61 into 5000. So 3.61 into 5000. Multiply this now. So 18047. Are you getting this? 18047. So is this greater than my investment? It is less than 18250, right? So I will not accept this. This will be rejected. I will accept this 10%. So accept only at 10%. This is your answer. You cannot accept it at 12%. Everyone got this? How did we get it? Did you get the problem? Because here this problem is a bit tricky one. Tricky in the sense you have to this considers the present value of money. The logic behind present value of money is whatever investment I make, it should always give me my present value of the future cash flows should always be greater than whatever I have invested. That's the basic logic. Okay. So are you getting this everyone? Okay. Move on. Clear this concept? Because if this question comes to you in exam, this present value question will be there in your CAIIB. Which of the following is correct regarding the buyback of certificate of deposits? Buyback. You want buyback now. Buyback means I've issued the CD. Means I'm the company. I've issued the CD. Certificate of deposit is what? It is basically the investment tool. Okay. Means I'll give you the CD. You will give me the money. Okay. So which one is correct regarding the buyback? Buyback can be done only after 30 days of the issuance of CD. Means today I issue the CD, I can buy it back tomorrow itself. Minimum 30 days. Let's see. But we want the correct one. I don't know whether which is correct. We want a true one. It is done at a prevailing market price. Means suppose if I've issued the CD at, let's say 10%, and after 1 month, let's say 1 month I am buying it back. If the rate going on is 12%, then I'll have to buy it back at 12%, not 10%. The bought back CDs can be reissued. Means I can reissue those CDs again to someone. So which one is correct? Think about it. 16th one, yes. The answer is only A and B. A is the answer. See here, buyback can be done only after 30 days of issue of CD. It can't be done before that. Okay. What is the minimum investment in CDs here? Minimum investment in CD is 5 lakhs. Always remember, minimum investment is 5 lakhs. Okay. CD and CP both have been made 5 lakhs now. So 30 days of the issuance of CDs first. Second one is what? It can be done at the prevailing market rate. Correct. Means even if I have issued, it's like issuing the share. Suppose if I give you the share at rupees 1000, and after 1 year if I am planning to buy it back from you, so I'll have to buy it back at that rate, whatever is going on at that rate, right? I can't buy it at today's rate, isn't it? It may be profitable for me, it may be unprofitable for me. Anything is possible, isn't it? Okay, so A and B is the answer. Which among the following is not an element of tier 1 capital? Not, remember, not an element. Revaluation reserve, paid up capital, statutory reserves, other disclosed reserves, perpetual non-cumulative preference shares, innovative perpetual debt instruments. Which of them is not? And E, I think so, it should be none of the, all of the above are the elements. Let me write it. Okay, yeah. By the time you think which of them is not an option, not the this part of tier 1. So which of them is correct? Revaluation reserves. Always remember, revaluation reserves are taken at 55% discount. Okay, so they are taken at 45%. Okay, so these are the part of tier 1. So this is true. Paid up capital, ordinary shares, statutory reserves, and other disclosed free reserves. True. These are also the part of your tier 1 only. PNCP, these are also the part of your tier 1. IPDI, these are also the part of your tier 1. Remember, tier 1 is made like this. T1 capital has two parts. One is CET1, and second is this 81, additional tier 1. Okay, CET1 has normally this share capital, shares means paid up capital, shares, then net profit, then reserves and surplus R&S, and revaluation reserves, reval reserves. Okay, these are the part of your CET1. 81, there are two parts which are there in your CAIIB. There are many parts, but mainly in two parts. One is PNCP and second is IPDI. Okay, so these are the parts of tier 1. Why? See here, these are also bonds only, but these are long-term bonds. PNCPs are generally issued. What is PNCP? Perpetual non-cumulative preference share. Means what? What is non-cumulative? Non-cumulative means if I issue the share today and if I don't give you the dividend in 1 year, so it's not compulsory for me to give you the dividend in the next year along with arrears. No compulsory dividend. Simple meaning is this. That is non-cumulative. Preference means what? Preference shares are always issued to those while starting the company. Okay. So perpetual, what do you mean by perpetual? Long term, very long term. Perpetual, anything perpetual means very long term. IPDI means what? IPDI is similar. Innovative perpetual debt instrument. This and PNCP are roughly similar. PNCP is also a part of IPDI only. Innovative perpetual debt instrument. This is a debt instrument. So PNCP is a part of IPDI. Okay. So all of them are the part of tier 1. All of them. Got it? Which are the reinforcing pillars of Basel II revised framework? Reinforcing. Which are the main pillars? Minimum capital, supervisory review, market discipline. Only A and B, B and C, C, A, B and C. So which are the reinforcing pillars? Reinforcing means which are the main pillars? Look at this. Basel II and Basel III. B2 and B3. Both are same only. There is no difference. Only in Basel III what they have done? They have done it enhanced. They have used the word enhanced. Otherwise nothing difference. See here, Basel II has 3 pillars. Okay. Three pillars. What are these? These are the three pillars. This minimum capital, I'll just write the short form now. Minimum capital, then SREP, supervisory review, okay, SREP. And last one is discipline, market discipline. Okay, market discipline. If I use this for Basel 3, they are same. But here only word enhanced is added over here. Enhanced. Everywhere enhanced. Same thing over here. Same thing over here. Enhanced word is added. Remaining thing is same. Why they have used the enhanced word? Enhanced word is used because they have added various ratios. For example, in your CRAR, for Basel 2 it was CRAR was CRAR. For Basel 2 roughly it was what? It was around 9%. Now they have added this buffer also 2.5%. So it is now 11.5. CCB, capital conservation buffer. Okay. So everything is enhanced. No, so remember the basic question over here is what? Which are the reinforcing pillars? All the three, A, B and C. All of them are the reinforcing pillars of this Basel norms, right? Basel norms are very important. Here, what is the formula for CRAR? CRAR is a basic formula you will be using in your BFM. Okay, capital upon RWA. Capital upon RWA. Okay, and always remember capital is of two types, T1 and T2. There is a third type of capital, T3, but that is emergency capital. So we don't take it in calculations. RWA is of three types: credit risk, market risk, and ops risk. So these are the three types of your RWAs. Okay, there are various numericals for this. I've solved certain numericals on this also. So follow it without fail. Okay. So the answer is D, final. Okay, all A, B and C. Now as I told you before leaving, I'll be showing you how to join the Adda 24/7 classes. Here, go to Adda 24/7. Always go through the app. In the app you get 1% extra using the coin systems. So go to Adda 24/7. Click on JAIIB and CAIIB. Look at this. Click on JAIIB and CAIIB. Okay. Click on CAIIB November. CAIIB November. Okay. Click on the crash course. See this crash course. Got it? Now, ebooks, test series, online live classes, expert faculties, interactive classes, recorded videos, everything is available. And click on buy now for the discounts. Put the code Y432. Never forget this code Y432. Click on apply. 77% off. Okay, 77. Huge. Plus 1 using the app. So 78% off. Okay. So don't miss this. Join it ASAP. Just now it has started. And you won't be missing anything. You have a recorded videos. Okay. So join